Welcome back to part 2 of how to become a startup investor. In the last video I shared why startup investing matters and how anyone, yes, even you, can get started. But if you are new here, hi, my name is Niklas. I'm the managing consultant at Spectup and I help growth stage companies to raise capital. Building strategy, ensuring investor readiness and reaching out to the right investors at the right time. Through Spectup X, I also handle private placement specifically for private and public traded companies and connect them with institutional investors. So I'm always getting to see both sides of the table, companies who want to raise and investors who are always looking for new deals. And that is why I started this series. I often read the same question in my DMs. How do I attract the right capital from the right investors? And on the other side, people who want to invest, they often ask me, where do I even get started? How do I even find startups before anyone else? So think of this series as a shortcut into this world. In part 1, we already covered the big picture. Why investing early in the right ideas can actually change your life. If you missed it, you can always go back. I will also put the link here in the description, so feel free to check out the first video before you proceed and watch this second one. But today is where it gets really exciting. I would say spotting the right opportunity is one thing. Actually sourcing and evaluating great startups is a completely different thing. You can say it as being the mastermind of the game. Did you see Squid Game? How there's always that one mastermind pulling the strings behind the scenes. Oh wait, we are not talking about death or life here. No, but in the startup world there is a singular role. The people who get access to deals before anyone else. And becoming the mastermind, this person who gets access first to these opportunities, that's where the real game begins. And that's what we are diving into today. How to source high quality startups, how to evaluate them like a pro, and how to avoid the traps that most first-time investors fall into. Let's start with deal flow. Think of it like fishing. If you are in the wrong pond, you are not catching anything big. Now here's where most beginners go wrong. They think good deals just show up in their inbox. They don't. You need to keep your networking strong for this. Every big investor is out there building relationships. Why? Because in the financial industry, trust drives communication. Let's say you know a person and they are sending a startup to you that is looking for funding. You know the person very good and you trust them. You see, the connection and trust, the risk and the fear that the investment can go down is now way lower. So you would love to invest in them because they came in through a connection. Just like the fact before you decide to buy anything, you would like to discuss it, for example, with your partner or your family or friends. It makes deals strong. And I would say about 70% of deals, they come in through these connections. So you really need to go out, meet new people, join startup events or some expos, build connections with them, hang out in founder communities. Let me give you a very quick story. One of the best deals I ever got into didn't come from a platform. It wasn't something I scrolled past online. It came through a founder that I did supported years earlier. And back then I had no idea that a small act of supporting would come back to me. But here's what happened. That founder later introduced me to another founder. And that intro turned into an opportunity that I would have never found on my own. So deal flow isn't about luck, it's about trust. If founders know you, if they trust you, they will refer you to other people. And that is your secret club. Also use platforms like AngelList, Seeders or OpenVC, where startups post their funding needs. I will drop their website link in the description box below. One other approach, post on LinkedIn or X that you are looking to fund startups. Sometimes the best deals come to you through your social network. You can also do some desk research. Platforms like Crunchbase are great for spotting early and very interesting opportunities. And if something catches your eye, don't hesitate to look for the founder name and reach out to them to ask if they are currently raising. That's also how I get my own clients. Just a simple message and a conversation. And if you are looking for a more hands-off approach, consider investing into a venture capital fund as a limited partner. Here, the fund does the heavy lifting, deciding which startup to back. You don't have direct decision-making power, but it's a way to gain exposure to very high-quality deals without managing every detail yourself. Now, once you have got the deal flow, the real question is, how do you know if a startup is worth your investment? I like to use 4 simple filters. Let me walk you through them with a story. The first filter is the founding team. For me, this is super important. Who are they? Why are they doing this? A few years back, I met a team building a niche logistics app. Honestly, their product wasn't really mind-blowing. But the founders, they had passion. They had failed twice before. And instead of giving up, they used these failures as lesson. You see, resilience. Today, the team is running a company and it's going quite well. And data supports this. Startups with experienced or repeat founders have a 30% higher success rate. So you need to meet the founders, get their background screened and get to know them. By knowing them, I don't just mean checking off boxes of metrics. I mean really understanding the founder. Ask them questions, watch their body language, and listen closely to what your gut says. For example, a few questions you can ask here. How did they react when they failed? Did they crumble or did they push forward? One of the first things I would ask in a call with a founder is, tell me about a failure you had and what it taught you. Honestly, the answers are revealing. I remember talking to a founder who had a product completely flop in the first year. Instead of blaming the market, they went back to the very first point. They listened to the users and strategized everything. And that was the signal for me. It taught me more about their potential than every revenue chart could ever do. Another angle I watch for is energy. What do people around them say about their focus, drive, and their ability to lead a team? Investors look for founders who can control a storm and inspire others while doing it. And here's the key. This isn't just about giving money. When you invest, you are signing up for being a long-term partner. You want someone you can connect with on a human level, someone whose vision you can believe in. I have seen great deals fail because the founder couldn't handle pressure. And I've seen middle people who were not very smart, but their startups performed very well. Why? The founder. He was ready to do. He never gave up. His leadership was on point. So when you meet them, don't just listen for facts. Find energy. It never lies. Find character. Attitude will be always there on the top. And see how they perform when things are in the opposite direction. That's what separates a fleeting startup from a company you will want to be part of for years. Next filter, product market fit and traction. These both kind of overlap with each other. You would be shocked how many startups build something that nobody wants. A quick test I use. Are customers really willing to pay or maybe wait in the line just for this solution or product? One simple example is Dropbox. Dropbox famously started with just a 3-minute explainer video before the product even existed. That video got them 70,000 signups overnight. So they did not get any money, but the signal was there. I would personally not invest in startups that are pre-traction. But traction does not mean revenue. Traction means more something like a signal. It can be a waitlist, beta users, letter of intent signed, anything that proves that people really want this service or solution. So it must be something that is really needed, and at the same time there must be also urgency so that people really get it. The next filter is market trends. And this one is crucial. Imagine backing a DVD rental startup back in 2010. You would be betting against it. But invest in streaming in the same year? You would be on the same fast-growing path as Netflix. Did you know this story? No, if you would be aware of this. There are hundreds of stories like this. Right now we are seeing waves in AI, climate tech and longevity. As of August 15, AI-related companies have raised $118 billion globally. And you know, the surprising part? They already exceeded the $108 billion from 2024. So, you know what's trending. Nearly half of the VC money is going into AI right now. So remember this. You are not just investing in a product. You are betting on people, on timing and their passion. That's what separates the winners from the losers. Now the last filter, and what I would always do personally. Jump on a call with the founder, see and check if you're on the same page. And for the call, prepare yourself a scorecard. So a scorecard with all the factors that really matter to you. Traction, team, market, whatever your priorities are. During the call, assign points as you go. That way you can capture all your impressions during the call and you won't forget anything. Sometimes just one call is enough. Other times you need maybe a second call, a third call, or even more. Now we learned how to catch deal flow and also how to evaluate startup opportunities. Now I have one question to you. If you have been on both sides of the table, investor or founder, what would be your priority signal to make a decision? Drop it below in the comments, I would really love to know this one. I often see founders and they pitch their businesses with charts that look like rocket ships. Revenue projections, market size, the whole game. But when I started to ask a couple of questions like where, for example, do your users come from, they were silent. So I asked again, and after some time we found out that all the 10,000 sign-ups were basically free trials. Not a single paying customer. I mean, if you don't have users, that's okay. But here's the red flag that most beginners miss. Founders who avoid tough questions. Growth that sounds too good without proof. And no clear path to real revenue. So better turn away before than late. It also taught me that the numbers can lie, but the founder's reaction never does. You need to dig a little bit deep to get these things. Now let me give you the other side of a different picture. Let's say there is this very small software as a service startup. On paper, it looks like not a lot of money. Honestly, most investors won't even bother to take the first meeting. But then you noticed one detail that stuck with you. Their churn rate was almost zero. Once people signed up, they never left. And their passion is also great. That kind of thing is telling you that their marketing is probably not the best. And they don't have many users, but the product solves a very deep and significant problem. So while others ignored them, you might be an investor who will catch this opportunity and invest into them. Sometimes the gold isn't the shiny numbers. It's hidden in the boring details everyone overlooks. You need to find that boring detail and invest into that. It doesn't need to be a startup that is building huge and crazy robots. It can be even a simple candy that is giving a healthy value to kids. Now let me ask you, if you were starting today, where would you look for your very first startup investment? Would you scroll through platforms like AngelList or OpenVC? Or would you try to go direct, building relationships with founders early? Drop your answer in the comments below. I'll be reading and replying and maybe even share some more secret tips how I personally decide for the best opportunities. I'll publish more on this channel, so we are just getting started. Trust me, you don't want to miss it. If you are now interested in investing in startups, or maybe you have started already, then you should definitely also join our Spectup investor community. We often give you access to high quality deals early because we get like amazing deal flow. So if this sounds interesting, I will put the link into the description box. So hit subscribe, stick around, and I'll see you in the next video.